Why is there so much buzz around asset-based finance today? Well, let's talk about it. Welcome to Uncommon Capital Quick Takes. Short episodes, smart insights, real-world investing explained simply. In just a few minutes, we'll break down one topic shaping private markets and the economy today. One of the fastest growing segments of the private credit markets today is asset-based finance, often referred to as ABF. While the term may sound new, the underlying concept has existed for decades. In many ways, asset-based finance can be thought of as the private market evolution of the asset-backed securities market. Traditionally, banks originated and funded many types of loans: consumer loans, residential mortgages, small business loans, equipment leases, and other forms of specialty finance. Over time, many of these assets would be pooled together and packaged into publicly traded asset-backed securities. Investors could then gain exposure to these cash flows through the securitized markets. Over the last decade, however, the lending landscape has changed significantly. Increased regulation following the global financial crisis, combined with the changes in bank capital requirements, has led many banks to reduce their participation in certain lending activities. At the same time, a growing number of specialized non-bank lenders have emerged to fill the gap. These lenders often focus on very specific niches, everything from aviation finance and equipment leasing to consumer credit, small business lending, renewable energy financing, and residential mortgages. While they originate the loans, many lack the balance sheet capacity to hold these loans indefinitely. As a result, they require financing partners. This is where private credit investors enter the picture. Rather than waiting for loans to be bundled into a public securitization, private credit managers can provide capital directly to these lending platforms. In essence, they're financing the originators themselves, gaining exposure to underlying pools of loans while negotiating customized structures, covenants, and protections. This direct approach can offer several potential advantages. First, investors may be able to earn an additional yield premium for providing bespoke financing solutions. Second, they often have greater control over deal terms and risk management than they would in traditional public markets. Third, asset-based finance provides access to a highly diversified set of underlying borrowers and collateral types, creating opportunities beyond traditional corporate lending. Of course, success in asset-based finance depends heavily on manager selection and underwriting expertise. Investors are not simply evaluating individual loans, they're evaluating the lending platform, its underwriting standards, servicing capabilities, risk controls, and historical performance. The quality of the originator is often just as important as the quality of the underlying assets. Ultimately, asset-based finance represents an expansion of the private credit opportunity set. It allows investors to access income-producing assets that were once largely dominated by banks and securitized markets, while potentially benefiting from enhanced yield, diversification, and structural protections. That combination has made asset-based finance one of the most compelling and rapidly growing areas within private credit today. I'm Brian Resnick, and this has been an Uncommon Capital Quick Take.